It started with a headache. Nothing dramatic, just the kind that creeps in after a long day, sits behind your eyes, and makes you think maybe you need more water, less screen time, better sleep. So she did what millions of people do now. She posted. Anybody else ever get a headache that won't quit? And then the advice came pouring in. It's probably stress. Try a detox. Cut carbs. My cousin had that. Magnesium fixed it. Doctors always overreact. Don't waste money on an appointment. So she listened. For 2 weeks, she took supplements that she didn't need, tried remedies that did nothing, and ignored the one voice she should have trusted, the part of her that knew something was really wrong. By the time she finally went in, the doctor didn't start with wellness tips or internet hacks. He sent her straight to the ER because it wasn't dehydration, it wasn't stress, it wasn't just one of those things, it was a warning sign. And the scariest part, almost all of it could have been avoided if she'd gotten real medical advice first. Because taking health advice from random people online can be dangerous. And financial advice is not much different. Bad advice can leave you with unnecessary taxes, costly mistakes, and years of damage. You don't see until it's too late. All right, welcome to Plan to Prosper. We are back again without Dalton. He's still enjoying life of a new baby. And so I am joined by my father, Doug McRae.
Hello.
And we are going to talk about advice that people give online, or questions that people pose and advice that are given to people online. Most of the questions that I found are real, and none of it is, we're going to talk about them, but because they are real, none of it is advice to anybody in particular, but we are going to...
Yes.
We're just going to brainstorm some of these because I think when you go through some advice, when you read through some of the advice given, there can be some decent answers and some not so decent answers, and sometimes it takes more of a conversation than just a straight answer.
Yeah, I totally agree with that.
And it seems like we're getting, maybe even with AI, but just a lot more online advice from people in general.
Oh, for sure. People are jumping onto various, whether it's ChatGPT or one of the various other sources. There always seems to be a new one coming out. People just posing questions there. But even the answers they get there, I think, are an amalgamation of all the various answers that have been created from sources that came before AI was there. So it's still a wild west out there as far as the answers you're going to get.
Yeah, AI is grabbing it, or is grabbing probably answers from people, but also just websites.
Right.
But then people are also just posing very personal questions online on like social media.
It's crazy. Yeah.
A client turned me onto a group that is a group of people trying to get to their financial independence age number as early as possible. And they're all giving each other advice. Some of it's good, some of it's not so much.
Yeah. I was not a financial planner early in my career. I did a couple of other things. I was a teacher, I was a lawyer, and so I had no real financial planning experience or background. And I remember getting the herd advice. I did not have a financial planner very early on, and some of the advice was okay. Some of it was pretty wrong. And so that's, for me, it turned out not to be a great way to do financial planning, just to kind of ask other people.
Mm-hmm. So yeah, we're going to go through some of these questions and just kind of brainstorm. And the first question, again, most of these are not made up. The first one I made up is kind of a softball and a current event. Somebody asks, how do I invest in this landscape of the war with Iran? And answer, sell it all, which we have seen a few different clients ask if that's the best answer and if they should do it.
Right.
How would you respond?
Well, it's very interesting you bring this question up right now because the Iran war is still raging. And I got that question about a week to 10 days ago from our oldest client, 101 years old, who has some money, and she sent me an email question basically saying, I really want to preserve my money for the next generation, and am I going to lose it all because of what's going on? This very morning, it's very poignant. This very morning, I just heard that she passed away. But I responded to her, and it's a very conservative portfolio that she has for obvious reasons, in a way that just basically tried to calm her down and say, look, we put a portfolio in place that gets you through the good and the bad. And obviously, she's 101 years old. She doesn't have a long time horizon, but she really wanted that to be something for her children. So I just kind of responded back to her and said, just like a lot of other events, this is not a time to bail out. There's probably going to be some short-term pain or negativity, but you never know. And we've seen it. Yesterday it bounced. About a week ago it was up 1% for the day or something like that. So it's bouncing around a lot now. We don't know when there'll be a major day of going up. It may not happen for quite a while, but if your portfolio is set up to withstand the good times and the bad, no, don't sell it all. That's bad advice. We've seen it before. Even in a year ago when Donald Trump came out with his Liberation Day tariff thing, the market went down 15 to 20% pretty quickly. One particular day, I think after that, the market was up 10% in a day, something like that. And if you had gotten out, you would have missed that part of the recovery. So by and large, if not always, selling it all is really bad advice.
Yeah, and just kind of make sure that you are set up in a portfolio that you can stomach, because like the 101-year-old is in a pretty conservative portfolio. My portfolio is not very conservative,
Right.
but I have a much longer time horizon, and I can withstand this kind of turbulence from geopolitical events.
Right. And they're generally short-term. And even in her case, yes, 101 short-term, I guess, but she was invested for her beneficiaries.
Right.
She didn't need the money. So there was no real, and that money is still invested today, and will move around as the markets move around for the benefit or the detriment, hopefully the benefit of those beneficiaries. But it's in a manner that she was comfortable with and has been comfortable with for a while and has served her very, very well. And we've seen a lot of bad times. One thing you and I both tell clients all the time, whether they're 45 or 65, is that you are going to see some really bad years. Assuming you live as long as we're projecting you to live, there are going to be some very bad years within that time frame. And we recommend this portfolio because it's going to withstand that. It's going to suffer too when those bad years come. Hopefully not as much, almost certainly not as much. But having a portfolio that meets your needs is one that you should. The best way for it to serve you well is to stick with it through those bad years.
And I wonder, you have a lot more experience in this, but I wonder if 2013 to 2020, people just kind of forgot, and now people forgot that there could be bad years. I mean, I think it was the fourth quarter of 2018 wasn't great, but that's like the only thing I can remember in that stretch. And now we've had COVID in 2020, 2022, which was a terrible year.
Right.
Last year with the tariffs last year was a great year, but the tariffs were a quick blip. And now this year with Iran, it seems like maybe there's more turbulence, but that people aren't used to after that long stretch of not a whole lot.
Yeah, it was very calm after the housing crisis, so 2008, 2009 timeframe. And we hit a bottom March of 2009. I remember it well. And things roared, or at least they rallied, and were fairly calm. The volatility was lower than normal for many years, to the point where everything you heard was, why don't I just invest in index funds? Because everything is up. Everything is going up. Doesn't matter what you invest in. And then, we had a couple of blips, and then COVID happened, and all of a sudden, index funds are no good anymore because, index funds own airline stocks, and I want to get out of airline stocks or whatever. And so it definitely has changed. It began to fray in 2018, but 2020, it certainly kind of went away. And we've been up and down since then. It's still been positive. when you add it all up, of course. But 2022 was a difficult year, and we're having some major movements now, up and down all the time. So it's a lot more volatile than it used to be. And so, people who grew up investing-wise after 2008 probably did get used to everything's going to go up, everything's going to be calm, a little blip here and there, but I don't even have to look at it. And then since 2020, certainly, maybe a little bit before then, people are watching it more closely because it moves around a lot more, which is good and bad.
Yeah. They're also more, I think, retail traders now, which up until I think I can't remember the indicator, but I was looking at or reading something about how retail traders have kind of taken a step back over the last 2 or 3 weeks. There's just been a lot less activity, and I wonder if part of that is the Zoomers not being able to realizing that they can't take volatility as much volatility as they thought they could in trading things like crypto and options and everything that aren't just going up right now.
Right, and I think because they don't know what to do. If you're trying to follow some retail herd that's saying now's the time to do X, now's the time to do Y, it's very confused right now. Even there, sometimes there's a herd that's saying, "Oh no, we got to do the following," but right now it's very confused. So I think a lot of people they don't know what to do, so they're frozen.
Yeah. Yep. With investing, make sure you set up a plan and have the ability to stick with it. The second question, now we're getting into real questions, and I copy and pasted these. So I can't remember if they read perfectly, but I'm going to read through the second question. I know that we should get term life insurance if we have dependents, which I do, 6 and 4 years old. However, I'm not sure if I should do 15 years or 20 years, and for what amount. I'm married, 40 years old, female, breadwinner, currently have $800,000 in retirement, maxing 401k, Roth IRA, HSA, planning to work until 55 and then part-time 2 to 3 days a week until 60, then fully retire. Here's my quote from a life insurance company. 20 years for $2 million, $1.5 million, $1 million, and I assume these are monthly premiums of $132, $101, and $69, and then 15-year term for $2, $1.5, and $1 million, $110, $85, and $59. I would love any insights from this great group. And then there was one edit. I currently make $150,000 a year, monthly expenses at roughly $7,000. I do have a mortgage of $3,500. House will be mortgage free in 20 years. Equity about $600,000. My husband is going back to school, so hopefully in a few years he can make $100,000. I have a 529 for both kids, putting in $300 a month for each. Currently, it's around $12,000. And so there were a variety of answers. Some of them got relatively detailed, but if you're just reading through, I also found this one answer, and the answer was the cost is so minimal between 15 and 20 year, I'd go with 20 years. What do you think?
With that answer or just the question in
with
general?
Both.
Well, first of all, obviously you're getting an online answer from someone who knows, at least because this is just an online answer, at least it's not from a salesperson or something like that. So it's someone with no axe to grind, I guess. So conceptually, it's not a bad answer. Oh, there's not much of a difference. So just get the bigger one. You'll have more life insurance in case something happens. That's not a horrible concept.
Bigger and longer term.
Right. And in her particular case, this is a woman who's the breadwinner, and her children are 6 and 4, so presumably 15 years will get them both to the point where they're either in college or beginning to be financially weaned. 20 years gets them to, they better be financially weaned. At that point, they're probably both post-college or at least towards the very end. But at least all the big bills are kind of done for those kids. So that's where sometimes a lot of the term stuff is targeted. But there are so many other issues. I mean, one thing we should probably make clear here is we do not sell life insurance at Stonecrop. We don't benefit from any commissions or anything like that. So we have no axe to grind. When we're telling people you need life insurance, we try to really help guide them to the types to consider and all that, and try to help find them an insurance agent who will do them right. One of the things to consider that is not in here is that, there's term life insurance, which is what is being talked about here, the kind of the cheapest coverage you can get, which is often what we recommend. Get something that's inexpensive that's going to cover the need. But there's also the potential to consider, do you want to make it convertible? Sometimes you have to pay a little bit more, but during the term, for a portion of that term at least, you'll have the option to go ahead and turn some of that into a longer-term policy, a whole life policy or something like that. So say maybe after 10 years or 15, boy, I'd like to keep $500,000 in insurance or $100,000 or whatever, and I can convert some of this to that and continue to pay premiums, but at least I'll have insurance forever. Presumably by then, her need for life insurance will have gone way down and maybe to zero. But if for whatever reason there's a need for continued insurance, she'll at least have that option, even if she's developed some sort of a health issue. So that's one thing that this doesn't talk about. And the other piece that this doesn't talk about is just kind of running a few more numbers to say, maybe this is more than you need. When we're eyeballing these numbers, I can't answer that question. Most people can't. But you kind of look at everything and say, okay, if you just presume for the moment that you've died and you have all these assets, and what are you going to presume about your husband? Is he going to make $100,000? Is he going to make $80,000? What do you want to conservatively presume there? So you throw that into the mix. You throw all your assets into the mix. Maybe you only need $500,000. Maybe you need more. So there's more to the answer here.
Yeah, I don't think expenses were in here. But the other, she's 40 years old with $800,000 in retirement. So she's already shown that she can save a lot of money.
Right.
But I think without expenses, it's basically impossible question to answer. Like, what do you want your expenses to be in retirement?
Right.
Or what does your husband want his expenses to be in retirement if something were to happen to you? But yeah, with the $800,000 and the amount she's able to save, I don't think it's an easy 20 versus 15 because I always like to think about getting term because I want to then self-insure.
Right.
After the term, after the term is done, because if you get most, I think everything, most other things are going to be more expensive. So you just take the difference and save that and let that grow, so that then that is essentially your insurance policy.
Yeah, totally agree that what you're trying. I mean, if you're trying to be financially independent, by definition, if you're financially independent, you probably don't need life insurance because you're financially independent. And the other piece of this is, oftentimes these are just wild guesses. I mean, anytime you see the word million, people draw a lot of comfort from that. I have $1 million in life insurance. I'm good. Sometimes we run numbers, and the numbers are way higher than that. And then we have to sit down with the client and say, okay, are we being too pessimistic on what your needs are going to be, or will your spouse go back to work, or will you move? Would you downsize? What else might happen, or will your expenses go down a lot more because whatever? I mean, sometimes you have high expenses, and if you're the one who passes away, they go down. So there are a lot of those kind of things that we make sure we find out from our clients that will help us to determine exactly the amount. But people draw way too much comfort, especially these days with inflation. Once they see that that M number, that million, they feel like, okay, I'm good. And maybe they are, maybe they aren't, but it's worth further exploration.
Yeah, I mean, I've run gaps where the person needs 10.
Yeah.
All right. Any other thoughts, or should I move on to the next one?
Move on to the next one, I think.
All right, the next one. My partner and I have reached our financial independence number, and he will likely leave his job within the next 5 years. One thing we'd like to keep open as an option is buying a house somewhere once we figure out where we want to settle long term. We're considering selling about $100,000 of stocks now to earmark for a future down payment. My thinking is that if the market were to drop significantly, say 40 to 50% in the next few years, I probably wouldn't feel comfortable pulling that much from the portfolio to buy a house, and we'd likely delay the purchase. The trade-off is that selling now would trigger a sizable capital gains tax, and this would be cash on top of our existing 3-year cash buffer for early retirement. So I'm trying to think through the best way to handle this. And then she poses some questions, but I think, again, scrolling through some of the answers, here's one of the answers I found. So again, both, I'll read the answer, but yeah, both thoughts on the answer, but also thoughts on the question. So the answer was, you're financially independent and someone will work another 5 years, likely giving you income not to touch your financial independence number, which ironically will give you a huge buffer. Whatever you do with $100,000 is pointless. Sell it now, pay tax now, withdraw it when the market is 50% down. None of this matters. You're above financial independence. Your cushion has 5 cushions. So don't fret and ask questions. Do whatever you want.
That answer is a classic answer that you and I could never give because we're fiduciary financial advisors and we need to give the right advice. There's not enough information here to be so glib about that. This person believes that, do we know if it's a he or she?
I don't know if it's...
My partner, yeah, don't know. Okay, so this person believes that they are financially independent. Okay, great. We haven't tested that. If they truly are, then some of the answer is correct. Like you're fretting about you're going to lose 50% of something you don't need. Essentially, is what they're saying.
Right.
I don't need this money. What if it goes down 50%? The other thing we don't know is, where are they living now?
Yeah.
Are they going to be selling a house, or is this a second home? And that's one thing. But then
also, real quick though, on that, the financial independence part, it is interesting how people think about that, because I wonder if this person would still consider themselves financially independent if the market were to go down 50%. Like, have they tested for that? Right.
And where's all the rest of their money invested? So presumably there's a lot more money here. They're not depending just on this asset, because if they're depending on this asset to buy a piece of real estate, they have other assets in 401ks or wherever that they're depending on. Is that, if they're worried about the market going down, losing 40 to 50%, then I guess they have 100% of their assets in the stock market.
Where they're really bearish.
Yeah, because if you've got a diversified portfolio and the market goes down 40 or 50, you're not going to go down 40 or 50.
Right.
Again, I'm old enough to remember watching client accounts in the 2008 timeframe, and the market, I think, ultimately it was in the 40% down. For the year, it wasn't down that much because it moved around a bit, but it was down. Let's call it over 40%. Nobody's portfolios that were diversified were down that much. They were down a lot. Mm-hmm. Don't get me wrong, but they weren't. People see that headline number. So people say 40 to 50% down. In the worst market year in almost everyone's lifetime, the market wasn't down 50%. And almost every portfolio that's diversified wasn't down 40%. And it did recover. So, that's a very pessimistic way to look at it. But, if you want to at least be prepared for a 40 to 50% downturn in the stock market, figure out what your portfolio would likely be down in that scenario. Do you have 30% in bonds or 10% or whatever, or some other types of investments? Maybe gauge what it might more likely be down, and go with that as your kind of pessimistic view. But even if it's 3 to 5 years, you're depending on a 50% drop in the year that you're going to buy the house. That's a real pessimistic view. But having said all that, if it is a short-term thing, if they really believe they're going to need this money in 3 to 5 years, it should not be aggressively invested.
Right.
Maybe some in the stock market, but there should be, it shouldn't be in cash. 3 to 5 years, it probably should be more aggressive than that, but something in between, so that, again, if the market's down 40%, let's just say, maybe you're down 10. Can you withstand that? Is that going to be okay? because the likelihood that you could be down 10 exactly in the year that you need to buy is not high, but possible. But so invest in a way that you think, okay, worst case scenario, the market's down this much, I'll be down this much. That's okay.
Yeah.
So that's how they should look at this right now. Even though it's money they don't need to be financially independent, you still want to invest wisely. And if you're going to need that liquidity in 3 to 5 years, don't be overly aggressive.
The other thing that we don't typically recommend is that this person has 3 years of, I presume, expenses when they say this would be cash on top of our existing 3-year cash buffer.
Yeah.
That's a lot of cash to hold. A lot of people don't realize that they think cash is safe without thinking about inflation.
Right.
So yeah, it's not typically our recommendation.
Yes. We typically recommend you have enough cash on hand. We start with a rule of thumb, but we never end there. So 3 to 6 months of general living expenses, but then it also depends on how volatile is your income. Are you commissioned? Or you get, and what's your situation like as far as your job, how secure it is, that kind of thing. And what are some big expenses that might come down the line? So all that stuff goes into how much kind of cash reserve you should have. 3 years is too much. Now, what they're thinking, I'm believing, and this a lot of people think this way, is, when I retire, I'm not getting Social Security right away. If they're eligible for a pension, it might not be right away. They're not required to take money out of their IRA until 75, probably, for most people. And so where does the money come from in the meantime? I better have some cash on hand. Well, that's not the way to think about it, because if, let's just say you've got 5 years, you retire, it's 5 years before you get Social Security, and even then you're going to have some sort of a gap. But during those years where I have zero income, where am I going to get the money? You don't need cash for all of that. What you want to do is have money invested somewhere that you can draw from on a monthly basis, and that can be managed in a way that's going to create that cash. So if you have, a diversified portfolio, you're presumably getting dividends probably every quarter. You're probably getting some interest income, again, if it's diversified and you have some in bonds, and presumably most years, not every year, but some capital gains that can be turned into cash. So that can be the engine that drives how you get your money every month once you're in retirement. Because, if it's all in cash and you're just drawing from that cash, and it's 3 years, in this particular case, 3 years of cash, all that money that's not going to be spent in year 2 and year 3 is just sitting there, not, maybe making, if you got in high yield, maybe it's making 3%, maybe. So that's not a wise approach to go. To be conservative, we love it when clients have about 6 months, at least 3 months. Most clients don't, when they walk in, don't even have that. So it's a process where we're trying to get them to that point, but 3 years is too much.
Yeah,
more than you need.
I didn't see. I mean, essentially, I guess the one other thing is just making sure you kind of firm up your plan for what you're going to do in terms of the house, and knowing timeline and knowing expenses and all of that, and not just kind of guessing on things and potentially, due to a guess, realizing unnecessary capital gains.
Right. Yeah, there are two issues that this brings up. One is just the cash reserve in general. So I'll take a second on that. When we think about cash reserve, really what we're looking at is, do you have liquid funds available if something bad happens or some cash needs? So you lose your job, you get ill, some big expense you didn't plan for shows up. Where are you going to get the cash? Worst case scenario, you don't have any cash, you're pulling out a credit card that you're going to have to pay 24% interest on until you pay it down. So you want to avoid that. And even worse case scenario than that is payday loans or whatever. You don't want to put yourself in a distressed situation. And so having access to liquidity is what's important. So we always look at it in stages. The most liquid money you have is in your checking account, because you can access that with your ATM and writing a check, or Venmo or whatever. So you've got your cash in the checking account, probably not earning anything with that, but it's not going to go down in value. So that's really important. The next is your savings account, which you can access pretty quickly, sometimes with your ATM, or at the very least, you can go online and move it to your checking account, and it's available probably same day, if not immediate. So those are the two most liquid things. Kind of look at your situation and say, what's the fastest, I will need that money, and that money is available same day. So how much, what's the likelihood that I'm going to need money same day? So make sure you have that amount of money available. And then there are other like online banks that might pay you a little bit more, the high yield accounts that might pay you these days 3 to 4%.
I think mine's 3.65 right now.
Yeah. So that's pretty good. And sometimes those are at banks where if you go online and push the button, it'll take a day or 2 or 3 to get it into your actual account, so slightly less liquid. The good thing about that is you won't use that money for impulse spending. You have to think about it. Think, okay, it's going to take me 3 days, so I'm going to move it over here, then I'll spend it. So it's kind of a good buffer to protect you from impulse spending. But that's still very liquid money. It's not going to go down in value. It's in cash, and maybe it's making a little bit of money. Beyond that, there are other ways to get liquidity. One is some people have home equity lines of credit. We don't love that as a first option, but it creates some short-term liquidity for sure if you need it.
Those are typically floating, right?
Floating rates, yeah. They're floating rates. So
the risk there is you get in at 3%, and in 4 years it's 6% or 8% or whatever.
Yeah, you don't want to borrow so much money from that, but I need money for 60 days. Home equity line of credit is a great way to get some money like that. And then so if you have other money that takes you a little bit longer to get, the home equity line can kind of be your bridge. And one of the places is just a general brokerage account. You say, okay, this account I think is for retirement, for long term, but I'm going to invest it in a way that there's always going to be some money I can draw from. So if it's a diversified portfolio where half is in the stock market and 30 to 40% is in bonds and 10, 15, whatever percent is in real estate and commodities and some other kind of alternatives, then no matter what happens, that money is going to be liquid because you can get it within 3 days generally with one of those accounts. It's more volatile, but it's still liquid. So those are really, with your cash reserve, you want to look at certain levels of liquidity and what money can I draw from. The last place you want to go is the retirement account because you're going to have to pay taxes and penalties potentially. And so that's the real issue there as far as the cash reserve. But then in retirement, or when you're financially independent and you're no longer working or earning an income, then the issue is, where do I draw my money from? If I'm getting Social Security and I look at my expenses and I see that I'm going to come up $4,000 a month short, where's that money going to come from? That's what your investment account now is for. And so we run those analyses all the time and say, if you take out $4,000 a month or $6,000, whatever the number is, and we add to that as inflation picks up year after year, that's sustainable. And so that's what you want to see. What's sustainable? If I take $12,000 out a month and we run the numbers and say that's not sustainable, you've got to cut your expenses a little bit. You can do up to 8. So we run those numbers all the time. So what you want to do is make sure you run the numbers with some conservative assumptions, look at it and say, okay, if I take $6,000 out a month and that goes up with inflation roughly every year, I'm good. And so you can just relax and pull that money out and create, from the liquidity created by either capital gains, interest, or dividends, or a combination. So that's kind of how to look at it in the retirement piece. And while you're not retired, the cash reserve, you just kind of want to look at your levels of liquidity.
Yeah, since you had mentioned the home equity, the other thing that I actually talked about last week was lending or borrowing against your investment account as well. You can do that.
Right.
So there's another area where you might be able to get easy liquidity as like a bridge instead of. I think they're similar. I know they're floating. It's floating as well, and I think the rate would be similar to a HELOC, a home equity line.
Right.
Yeah, so just another area you can go.
Yeah, and so those are good things to kind of a home equity line and that kind of line is good to set up when you don't need it. They always tell you, get it when you don't need it, and hopefully never use it. But if you really do need it, it's just nice to have that there. Hopefully just for a short-term bridge, because sometimes what people do, and we've seen this happen over and over again, they have a short-term need for cash, and their only opportunity is to take money from a retirement account. Then they're playing these games where if you can take money out of retirement or out of an IRA, as long as you put it back within a short period of time, you're okay. But then what if something happens and you can't get it back in there? All of a sudden now
You get penalized and everything,
And so having a better backup plan, like a home equity line or something like that, is better. And again, it's something people tend not to think about when things are going well. That's when you should think about it. Make sure I've got that as a backup. Costs a little money to get it, but not much.
The other interesting related thing, just because you had mentioned ATMs that reminded me of it, is in this season where there are questions around the markets and everything. Typically, gold does well.
Yeah.
Gold has not done well over the last week or so.
Strange.
I heard one analyst's take being that people have a harder time selling something that's down than they do selling something that's up. So people are looking at gold as their ATM right now, and that's why it's so they're only selling gold to create liquidity for themselves, which is related here because that also might not make the most sense from a capital gain standpoint of what you should realize. There are different ways that you can look at how to realize, and you can maybe realize a mix and lower or not incur as much capital gains. Right. So yeah, just kind of a different way to think about that too.
Yeah, for sure.
The next question, how do you deal with the fact that you may not be comfortable investing in companies that you don't align with? For example, buying VTI, which is the Vanguard U.S. stock market fund. It's the total, so it's not just like S&P. It's like everything in the U.S. You're investing in companies that you probably wouldn't support outside of buying their stock. And then this person listed, think fast food, military, defense, hazardous chemicals, etc. And then one of the answers was, I don't make investing decisions based on emotion. I buy VTI and choose to not be a customer of businesses I don't like.
Yeah, it's almost you should probably almost think the opposite way, because I've often heard it. Let's just say it's a convenience store chain, and there are many of them, and they're carrying pornography, pornographic magazines or whatever, and there are two thoughts. One is, I will never come back to this place because I don't want to support a store that supports pornography. And the other one is, I'm going to keep going to the store, but I'm going to show them by never buying that pornography. So hopefully or I'll complain about it. Maybe they'll take it off the shelves. So I'm trying to exercise influence as a consumer by still going to that place, but not supporting the part that I don't like. And so one way or another, as a consumer, that's kind of the thought process you go through with that. And we make those decisions all the time. I'm not going to go into that store because they're supporting X or whatever. And so you kind of, or I'm not going to buy this thing on Amazon because it's a bad product. There's sometimes if there are some products where we think, okay, they're part of their supply chain is slave labor in China. Okay, I'm not going to buy that product. So you kind of do that. With the stock, you're actually supporting the entirety of that company, and kind of forget emotion, but you're profiting. You're profiting from what they're doing. So now, if it's that convenience store chain and they're making money off of pornography, then you are profiting from pornography, even if when you go into that store you don't buy those items. So that's kind of the way to think it through. And one of the things that you have to try to bring it closer to home, because if you just buy VTI and it's not a nameless, faceless thing. You're investing in a whole bunch of companies,
Like 3,000.
yeah, that are active in a lot of different things. Some of those companies are fine, and we need them. And many of those companies are not fine. They're doing things that are hurting society. So if you're like an active person politically, or if you're an active person religiously, or if you're an active person in your community, and you're trying to push things in a certain direction, it's for sure if you're in VTI, you're actually buying things that are fighting against that very thing. And so it's probably a losing battle. You're probably one step forward with your personal activities and 3 steps backward with what you're profiting from. So that's really the analysis that an individual should do. Am I comfortable because anytime you're in an index fund, you are certainly invested in things that you personally would find reprehensible. No question about it.
Yeah, and even potentially, like I was talking to, this was a couple years ago, but a ministry organization that tries to help people stop smoking.
Yeah.
And so their donors and their programs and everything they're pouring money into different programs and resources and everything to try to help people stop smoking. And at the same time, they were in, I think it was just S&P 500, but so Altria I think is still a top 50 to 100 weighted stock in that, and so they're on one hand trying to help people stop, but on the other, if all else equal, if people stop smoking, then the Altria position in their portfolio is going to start falling.
Yeah, and even worse than that, someone may say, well, I'm trying to help people stop smoking, and Altria creates cigarettes in this country, but people are adults; they can make up their own mind, and they're not allowed to advertise. So maybe it's not so bad, even though it's dead set against what they're trying to accomplish. So that would be a hard argument to make, but one that you might hear. But that same company is going into countries all over the world and marketing cigarettes the way they used to when I was a kid, and that is hand out free cigarettes to kids in elementary schools. And so even though maybe you're making a dent with your ministry in the United States by supporting those companies by investing in an index fund, you are actually, it's going backwards because there are more. How do you create smokers? You get them addicted early, and that's what they do. Mm-hmm. That's what they're profiting from. That's where all the growth is. The growth market isn't the United States, actually,
because of the regulation.
Right. The growth market for these entities is overseas.
Mm-hmm.
That's where they profit from.
Yeah. Work on making sure that you're not. There aren't discrepancies in your life in that manner. And then the last question. I want to open accounts for my kids to give them a head start. I was researching the different types of investment accounts for kids. Can you share your experiences with these? What's my best option that won't burden them with taxes one day? Roth, UGMA, and that's the end of the question. There are other things that we can talk through there. One of the answers was brokerage in your name until they start working. When they have income, transfer the amount of their current income into a custodial Roth IRA. Once they are 18, you'll have to come off it and it will be theirs. I told mine from the get-go they are not allowed to touch it ever.
Yeah, it's interesting, that last part. I'm telling them they're not allowed to touch it ever. You always need to realize that if you're giving someone money, a child money, in an account, any type of account like that, custodial type of account, once they become an adult, they can do whatever they want.
Which I think it's dependent on the state, right? Whether it's 18 or 21.
21, depending, yeah. And oftentimes, from a practical perspective, parents will open up some sort of a custodial account. It can be when you said UGMA, Uniform Gifts to Minors Act account, that's where that comes from. Or UTMA, Uniform Transfers to Minors Act accounts. That's the fancy wording for those. But those are essentially custodial accounts. Or a custodial Roth account.
Custodial meaning the parent is the custodian, right, or somebody who's not a minor.
Correct. Yeah. So if a parent sets up one of those and the child is essentially the beneficiary, then they, or the co-owner, whatever you want to call it, but legally they can't own anything. So you've got a custodian who's owning it, but because of the way those accounts are set up, automatically they will go to that child at some point and they will have the rights to it. From a practical perspective, often what happens is the child doesn't even know it exists. So when they turn 18 or when they turn 21, they don't even know to say, hey, this is my money, I can do whatever I want with it. Or because there's some moral authority.
But the brokerage typically forces it.
Often, yeah, that's been what's been happening. But oftentimes they'll force it, and the parent will just go to the child and say, here, sign this.
Yeah.
And they still have very little knowledge of what's going on, and the parent still controls it to a degree, if they can try at least. But again, from a legal and from ultimately a practical perspective, eventually that child's going to catch on and say, this is my money. And if you set it up when they're 3, 4, 5 years old, you don't know what they're going to be like when they're 18, 19, 20, 21. God forbid they're a drug addict or just somewhat irresponsible or whatever. Are they going to make good use of that money? So that's something you always have to enter into the equation. I'm not saying don't use them.
And how much will it grow? How much are you going to put into it? Because
Right.
they could end up getting a lot of money at 18
Right.
or 21.
So just make sure it's an amount that won't harm them if, at age 21, they're not making good decisions. Because a lot of 25, 28-year-olds who are very, doing very well weren't making good decisions when they're 18, 19, 20, 21. And so you want to make sure it's not so much money that you're going to harm them. But having said that, money in a custodial Roth IRA, we kind of love those because it is money that if most children, when they see, oh, I've got $8,000 in a Roth IRA, they say, well, what's an IRA mean? Oh, it's an individual retirement account. And they realize, oh, so that's money I can't think about spending now. So most kids, when they get that money, let it stay there, and now you've gifted that child decades of tax-free growth. So it's a wonderful thing. But you have to make sure that child isn't going to be so desperate financially that they're going to draw that money out, because they can. So we like the Roth IRAs at least to give them some sort of a head start on financial independence. The idea of putting in just a regular investment account that doesn't have the child's name on it is not a bad idea. We actually like that too because it's in your name. Yes, you're going to get taxed on it every year, but it's growing most years depending on how you invest it. And when the time comes, you can still gift it to them. But if it's not a good time to gift it to them, in other words, they're not making good decisions at 21, you can wait till they're 25 and say, okay, now I'm going to start giving you this. So you have complete control over that. And if ultimately they're doing so well they don't need it, it's your money. You can retire on it. You can use it for whatever you want. And then the UGMA accounts or the UTMA accounts, the custodial accounts, they're pure brokerage accounts. They don't give you any tax benefits.
They give you a little bit.
At some point, because they get taxed on their.
It's like up to some. It's in I think it's like 1,500 or 1,800 or something isn't taxed in capital gains.
Right.
And then the next 1,500 or 1,800 or whatever is taxed at the child's rate. But then after that there's no
right
benefit.
So there's a small with the small balance accounts there's some benefit. And there's something called the kiddie tax, which means until they reach a certain age, whatever the tax rate is going to be the parent's tax rate. So you're not saving any money by moving money. Years ago, the reason they came up with the kiddie tax is people would put all sorts of money in their kids' names so that the money would get taxed at the kid's rate, which would be very low because they're not earning income.
But then how do you get it back?
You just take it back. You put
okay.
you put it in a custodial account or something like that, and then you just draw it back. People would do that. They put the kiddie tax in place. But even if they didn't take it back, it would be money that they would kind of displace and move over, and they would save themselves a lot of tax by doing that sooner rather than later. IRS didn't like that. Congress allowed the IRS to kind of close that loophole. So that you're not getting much of a tax break by doing that. And so if you're going to use a uniform gift, a custodial account of that sort, that's money we really say plan on that being money that they have access to when they become legal adults. So maybe you want to do that so that they have some money for a down payment on a house or some extra spending money if they go to college or learn a trade or start working. But don't let that be too large. It's almost like the estate planning thing. If you're setting up your will, don't say my kids, and you have young children, don't say my kid, let's say you have 3 children, don't say they each get 1/3 and leave it at that. Because if they all get 1/3 when you die and one of them is 16, first of all, they can't, but they'll get it all at 18. And is that a good idea? And so you want to set it up in a way that makes sense. So you say, well, wait till they're 25 or give it to the hands of a sibling or something as a trustee who has discretion to give it to them when they're ready. It's the same kind of mental thing you're thinking of there. Don't put too much money in the hands of someone where it might hurt them.
Yeah. And then the last one that wasn't even really mentioned was 529s.
Right.
Which serve a very specific person. So we're seeing less demand for them, I think, lately. Clients coming in that are a little bit more hesitant on the 529 because they're not convinced their kid is going to go to college and use all the 529 money. But if you have a pretty strong confidence that is going to happen, that'll provide you with the biggest tax benefit because everything grows tax-free,
right?
As long as you're taking it out for the right qualified education expense reasons.
Yeah, and because those accounts the laws have been changed to make it much more broadly available. It used to be college only. It was never really strict on what you could spend for college. So if it was off-campus housing or buying a computer, that was always pretty much allowed. But now it can be used for K-12 education. And the other thing is you can move it from child to child. So if you have 2 or 3 children and one child has too much in theirs, you can shift it to another child. You don't have to take it out by any certain age, so you can kind of leave it in the account for a while you figure things out. So, okay, wait a minute, I now have a grandchild, let me move it there or whatever. So there's a lot of flexibility, including taking some of the extra and putting it into a Roth IRA for the child. So there's all sorts of things that can be done there. But we generally recommend don't target 100% of a potential college education covered by 529. Target maybe 50%. It can be used for trade schools too now, right? Pretty sure.
I believe so, yeah.
It's gotten a lot more broad. So if they don't go to college, you have some options. Worst case scenario, you take it out for not college or not education reasons. You pay a 10% penalty on the growth.
Yeah.
And income taxes on the growth. The principal is intact, doesn't get taxed. And so there's a potential penalty there that you do want to avoid. That's why you don't want to overfund them. But it's usually a good place to, let's say, I had just had a child. I'm going to set up an account. Not doing great now, but I'm going to put $100 a month in just to get it started. And, grandparents can put some money into those accounts. So it's usually a good thing to have to make sure you have some sort of a chest of money available when the time comes.
Yeah. Yep. That's all the questions that I went through in my spare time of looking through personal financial advice online. Overall, I think kind of the recommendation is there are a lot of different aspects of each person's financial life.
Right.
And so like going to a doctor where somebody's headache might be one thing and somebody else's headache might be another, you should consult with a professional who knows exactly what to look for,
right?
Instead of asking the entire universe based on an online post.
Yeah, and I guess the other thing that we should probably add, how much are we?
6 minutes.
The other thing we should probably add to this is that even in the financial profession, be somewhat educated and wary as to who you're getting advice from and how they get compensated and what their incentives are. And so we see all the time people coming to us after already doing something with someone who sold them something. and I'm not saying all these products are bad, but an annuity, a life insurance policy, a whole life insurance policy, or something like that. And ultimately, when we tear it down and take a look at it, sometimes they're appropriate. Sometimes there's nothing we can do about it because they have 5 more years of surrender charges, and okay, you're stuck with this, so we'll work with it. But you want to make sure you fully understand who you're talking to. If their compensation is based solely on selling you a particular product, and the bigger the product, the more they make, then just be a little wary of that, and make sure you understand that there's some very, very good people out there who sell insurance, who sell annuities, that are highly moral people and won't sell you the wrong thing. That's a caveat. It's probably the majority of those people, but I don't know. But there are definitely people out there who they need a payday, so they're going to try to sell you something you don't need. So really be careful about that, and that's it. One of the reasons why we're set up specifically to never earn a commission on an insurance product, on a financial product, on anything of that nature, because we wanted to put ourselves in a position where we're just kind of very objectively looking at your situation and say, yeah, you do need insurance, or no, you don't need insurance, or an annuity might be helpful in your situation, or no, it won't be helpful in your situation, or you've got an annuity and you're stuck with it, so let's work around that, or whatever. But you really want to go to someone who's going to have some level of objectivity. Of course, if you walk into our office, we're likely going to want you to become a client. So there's we're going to give you our best objective advice. And one of our advices, one level of advice often is you should hire us. So yeah, we don't have objectivity there. We want you to become a client. Generally, when you walk into our office, but we act as fiduciaries, and we're going to try to do what's best for you, legally and morally. And so you want to make sure if you're going beyond the retail, I'm going online or going to AI or going to wherever to get some advice. If you're going beyond that and actually going to a professional, make sure you know what kind of professional they are and what their incentives are.
Yeah, don't end up with Kyle Busch's insurance agent.
Yeah, you've done an episode on that, haven't you?
I think we mentioned, we walked through a little bit of that. I think I'm all set. Think we're good to wrap it up? All right. We'll see. We might have Dalton back next week. We might not. We'll see. But we'll definitely keep him coming. But yeah, God bless.
Investment advisory services offered through Stonecrop Wealth Advisors, LLC, a registered investment advisor with the U.S. Securities and Exchange Commission. This material is intended for informational purposes only.